Alright, we are on Chapter 6. Chapter 6 covers computerized systems, cash, and payroll. So this section of Chapter 6 talks about safeguarding cash. Alright, safeguarding cash, you have to set up internal controls to safeguard cash. We're going to discuss these internal controls here. Number 1 is maintaining physical safeguards. 2, segregation of duties. 3, transaction authorization. And 4, record retention. That's not gonna mean much to you, but we're gonna go over these so you understand the internal controls better. So an example of maintaining physical safeguards. Making sure that only authorized personnel have access to cash registers. Making sure that the cash registers are emptied before the end of the night and put into a lockbox. So an example of this would be if Anne at Greater Athletic Performance, she had all her cash registers full, and Greater Athletic Performance had a robbery overnight, and she found out that $15,000 was missing from the robbery. There's no way of getting that back because the cash was in the register and the thief took the cash from the register. Segregation of duties is making sure that those that are in charge of billing and paying are not one person. So they have separate duties. So if someone's in charge of billing, you have to have one person in charge of billing and another person in charge of payments. Because if you have one person in charge of the two roles, billing and paying, they can steal money. So an example would be Anne at Greater Athletic Performance hires someone and they put that person in charge of billing and paying, and that person creates a fake bill for a company. Then he produces a check for that payment, but deposits that check in their own account. So that person should have segregation of duties, so they're not in charge of billing and paying, so they can't steal cash from the company. Right? Transaction authorization. Only managers or owners should have authorization of large purchases. So an example, Anne hires a girl to work in her organization, and she has access to purchasing anything she wants, really. So she purchases a large amount of furniture for the organization, and it totals up to $25,000. Well, that wouldn't happen if they had transaction authorization and Anne had to authorize the transaction because she would know about it. So that's transaction authorization. Record retention. Record retention requires that you keep all your receipts, all your check stubs, your bills, all of them for at least 7 years. So that's record retention. And an example of this would be Anne hires a new accountant or someone in charge of bookkeeping, and that person goes through the records and realizes that there's $17,000 missing, but there's no records that were kept. So that money is just stolen from someone, and they don't know how it left the company because they don't have the records. All right, so record retention, 7 years, you have to keep the records. So all of these are internal controls, and we're going to discuss external controls and how it safeguards cash, external controls. Another way of safeguarding cash, you have internal and external audits. So you have both internal controls and external controls. But an internal audit would be someone from within the organization that's not related to the role of anything to do with the cash account. No billing, no purchasing. Someone from outside that role coming in and performing an internal audit on the cash-related activities. And the same would be an external audit, but it would be someone from outside the organization that has no association with the organization whatsoever coming in and performing an external audit of the organization's cash-related activities. Now, you can have all these internal controls and the external audit or external control of external audit, but theft can still happen. You can have all of these things, but theft can still happen. Segregation of duties prevents one person from being in charge of billing and being in charge of purchases, so that prevents them from stealing as an individual. However, collusion can happen where a person in charge of billing and a person in charge of purchasing can collude together and steal from the organization. But these are ways of preventing it and limiting theft from the organization. So these are the ways of safeguarding cash, and we're going to discuss a little more in Chapter 6, but these are ways of safeguarding cash and the internal and external controls. Alright, so every month the company's bank, issues a bank statement, just as you would receive a bank statement for your checking or your savings account. And many times the bank statement's amount does not match the cash account in the general ledger. So reasons for this, the reasons are sometimes there's things happening in the company that the bank doesn't know about. Sometimes there's things happening in the bank that the company doesn't know about. And we're going to discuss those things. A deposit in transit. So if a deposit in transit is made at the end of the month, the company is aware of that deposit, but the bank hasn't had time to process it, so it would not show up on the bank statement. It would show up in the general ledger, right? Outstanding checks. An outstanding check is when the company sends out a check to pay a bill, and that individual or that company does not deposit the check right away. So the company knows about that outstanding check, but the bank would not know about that outstanding check. So therefore, the balances would be different because of that outstanding check. Notes receivable collected by bank. Sometimes companies set it up where companies can pay them directly to their bank account. So the bank would be aware of those notes receivable, but the company would not be aware until the bank statement comes out. NSF check. An NSF check is a bounced check. So the company deposits a check from someone that owed them money, and the check bounces. The company is not aware of it, but the bank would be aware of it. So the bank would be aware of the bounced check, but the company would not be. Bank charges. So for example, for that bounced check, the company may be charged for that bounced check because the bank would charge them for that bounced check, and the company would receive it later on within the bank statement, but they wouldn't know about that in the general ledger. So those are the differences. Those are the things that could make the bank statement different than the general ledger. And we are going to walk through this bank reconciliation. Alright, so we're going to walk through this bank reconciliation for greater athletic performance. We're going to walk through it to see how these differences can be adjusted and reconciled. Alright, so for greater athletic performance, the bank statement displayed an ending cash balance Oh, before I start, I'm sorry. Another reason for differences would be bank errors. So if you deposit $2,000 in your account and the bank erroneously records it as 200, you'll have to make adjustments for that error. So we're going to see an example of that in this. So the bank statement for Greater Athletic Performance had an ending cash balance of $14,250. So bank statement balance you see here, $14,250. The general ledger displayed an ending cash balance of $13,700. So you got a book balance of $13,700. A check was written by a corporation for $250, but was rejected by the bank for insufficient funds. So we have to record that on the company side because the company didn't know about that bounce check, but the bank did. So we have the NSF check or bounce check of $250 here. The following outstanding checks had been written by month end. So the company knew about this, but the bank did not. All right, so check number 007 for $145 right here. Outstanding checks, 007, $145. Check 013, $35. And check 015, $90. All right, so we have our outstanding checks listed there. The bank charge for the month totaled $75. So it could have been $75 for this bounce check. We don't know what the bank charge was exactly for, but it was a bank charge and it was for $75. So we record that on the company side because they didn't know about it till their bank statement, right? Bank charges $75. On behalf of the company, the bank collected a notes receivables for $600 from Sports Inc. All right, $600 was received by the bank, so the bank knew about it, but the company didn't. So we have to put add notes receivable $600. Deposits in transit totaled $355. Deposits in transit. So we have our deposits in transit that the bank didn't know about, but the company did. Deposits in transit totaled $355. So we have to add these, right? $355. The bank erroneously reduced the company's bank account balance by $370 for check number 009, which was written by the company for $730. All right, so the bank error would be adjusted here. Bank error for check number 009, and it would be $360. The $360 adjustment for the $730. All right. So then we tally all these together. So we take this from this, we add this to get 14,605. Sorry, this 6 looks bad. 14,605. So this is 14,605. And then we subtract all of these from the 14,605. So these total up to 630. So we get $13,975 as our adjusted bank balance. Then we go over to the company side, and we got $13,700. We have to add the notes receivable of $600, which we get $14,300. But then we have to subtract these, the NSF check and the bank charge, and we get $325 that we have to subtract from the $14,300, and we get a total of $13,975. So our bank statement and our general ledger are reconciled through our bank reconciliation. So that's how you do a bank reconciliation.